Good evening. The last few days, and certainly the last few moments, have been dominated by a discussion sparked by the announcements by the ANC Secretary-General Ace Magashule that the party's NEC Lekgotla agreed that the inflation targeting mandate of the Reserve Bank should be changed. Hours of his statement on Tuesday, the head of the ANC's Economic Transformation Committee, Enoch Godongwana, told the SABC that no such decision had been made and that the Lekgotla did not have the power to change an ANC resolution taken at its Nasrec conference. Then, this afternoon, the ANC released a statement on behalf of its top 6 national leaders. It came from the ANC presidency, saying that the policy on the Reserve Bank mandate has not changed. Then, about 24 minutes after that, the Twitter address of the ANC Secretary-General, Ace Magashule, tweeted a statement that seemed to indicate that it had changed. That tweet was then deleted, and the Twitter account of the ANC Secretary-General said that it had been tweeted in error. In the meantime, there's been a huge discussion about whether the mandate should change. Currently, the bank uses interest rates, the rate at which it lends money to other banks, to target inflation. If it lowers those rates, you will have more money in your pocket to spend, which leads to higher inflation. If it raises interest rates, you'll have less money to spend and inflation is thus controlled. Well, that's the theory. Before I introduce my two guests, let's listen to one of the role players in this. Enoch Godongwana, who has strong views on this, he's the chair of the ANC's Economic Subcommittee. He's been speaking about this week.
The fact that the South African Reserve Bank is in private hands is a historical anomaly, because after the Second World War, most central banks were transferred into public ownership. That is not in dispute. There's a second aspect of it, is that can we interfere with the Reserve Bank in performing its day-to-day functions? The answer is that that's protected by the Constitution. We should not interfere with that.
Enoch Godongwana speaking on SABC News. That full interview available for you on sabcnews.com. We'll speak to two people who have different views on inflation targeting tonight. Enoch Godongwana is the founding director of the Centre for Economic Development and Transformation. He will speak for himself, but I'm expecting he'll argue that the mandate of the Reserve Bank should change. Gina Skuman is the South Africa economist at Citibank. I've asked her to take the position tonight that the bank's mandate should stay as it is. So that is the conversation that we'll be having here on the record. All right, Gina, good evening, both of you. Thank you so much for coming in. Gina, let me start with you. I mean, why is inflation targeting important? The mandate that the bank has at the moment, why is that so important to the economy as it is right now?
Well, South Africa's economy is an open economy, so that means the currency is tradable. In South Africa's case, our currency, the rand, is highly tradable versus other currencies. So price stability is important, because price stability in the end is inflation. And at the heart of all of this, if you look at GDP growth in South Africa, 2/3 of it is made up of household consumption, which is consumer spending. What drives consumer spending is real disposable income growth. So if inflation goes up too quickly, it eats away at nominal income growth, and you're left with very little to spend. Now, we have also seen in the past, and this is why they introduced inflation targeting, is that inflation is the most toxic, or one of the most toxic things to economic growth in South Africa.
So what you're saying is that if the price of goods is too high, people can't buy anything. It's as simple as that.
If it goes up too quickly, yes, then it will erode their income.
Duma, you've consistently argued the mandate must change.
Yes, okay, so let's step back and talk about the spat. You know, I think it is rather disappointing, because our economy has collapsed 3.2% in the first quarter, and many of us had warned it that the government's economic policies would result in such an outcome. And what we really need is some leadership from the government on the issue of the economy. And with all these statements, I haven't seen any leadership. The ANC should communicate with one person on economic policy, and it's fine for Enoch Godongwana he shouldn't be releasing statements after the Secretary General. He should have had sight of the statement before it was released, so they should work together. And I have to say as well, I think the governor and the finance minister were adding fuel to the fire, and I think the governor especially has overreached his... you have to distinguish between political independence and operational independence. Very few central banks in the world, including ours, have got political independence. So I think issues of political independence are not his call, and quite frankly, he should keep quiet on those issues. The political goals of a central bank are set in a democratic process in a parliament, and it's based on that. Yeah, that's what I wanted to say. Now, back to the mandate, is that we should separate issues. So there's the whole issue of the nationalization on the table. There's the issue of the independence. There's the issue of the mandate, and the issue of the quantitative easing. That's what we've been debating over the last few days. So the nationalization, they're all different things which are not related to each
I get
other.
that.
Yeah,
and I mean, there seems to be a debate between quantitative and qualitative easing as well.
Yes, yes. So let's start.
But just specifically on the mandate.
On the mandate. So the mandate. So the mandate should change, in my view. And then the second thing is that the quantitative easing has got nothing to do with the mandate.
I'm going to ask you to stick to the mandate.
Okay, the mandate.
Because it's too complicated. I'm not an economist.
Okay, sure.
So let's just stick to the mandate tonight. Why should the mandate change?
Okay, the mandate should change. Most central banks in the world do not just look at inflation.
Yeah.
A central bank 20 years ago, former governor, he wasn't governor then, Mervyn King, he said that central bank governors who just look at inflation only and don't look at the real economy, they're inflation nutters. So today, most central banks look at more than inflation. So what we're seeing in the world today, central banks throughout the world, they're cutting interest rates because of threats to the global growth situation. The US did a policy U-turn at the end of January. Today, the European Central Bank said they're going to do whatever it takes to present a downturn. India cut interest rates today, Australia earlier this week. So what you're seeing is that many people are responding to the slowdown in growth and not inflation, and also in developing countries. And China is reflating its economy. So we are so far behind the policy curve. That's the first thing.
Okay, can I just pick up on that?
Yeah.
Isn't it true, though, that our inflation, among all of the examples you've mentioned, I can't speak for India, but certainly Australia, Europe, all of those places, our inflation is much higher than theirs.
Yes, yes, but I'm just saying, even if you look, so what I'm trying to say is that as South Africa, our economy has collapsed. And it calls for us to use all the tools that are available to reflate the economy. Now, if you look a bit back, the Reserve Bank has kept interest rates way too high if you look over a 30-year period. If you take from 94 to 2009, we had a real prime lending rate of about 9%. That is punitive and usurious. And that is what has kept our economy back. Because when you want to invest, you look at the cost of capital, you look at the growth of the economy. Will I be able to sell the things that I want to produce? Now, when the cost of capital is too high and the growth rate is too low, you say, no, I'd rather invest in liquid assets. I can't invest in the economy.
Okay, so if rates were cut right now, right? I think that 6.75% is the rate now. If it was cut to, say, 3%, what would happen?
Okay, so what I'm trying to say is that, okay, we've had many episodes of rapid rate cuts over the last 24 years. Let's start in the late 90s until the early 2000s. They came down by more than 1,200 basis points. After the in the early 2000s, they came down by 650 basis points until 2005. Also, after the global financial crisis, Jill Marcus brought down interest rates, I think, by 700 basis points. There was no hyperinflation that resulted from that. There was, the second incident, there was a boom that followed, and there was a modest recovery after the global financial crisis. So what I'm trying to say is that when the economy is in recession, there are various tools that countries use to reflate the economies. It's fiscal policy, monetary policy, and exchange rate in the short term. Yeah.
All right, Gina, do you agree? I mean, if we had to cut interest rates now to from 6.75 to 3%, what do you think would happen?
Well, interest rates, honestly, the bottom line here is that we have an an inflation target of 3 to 6%. Communication from the SARB up to this point has been the midpoint is 4.5%. That's their target. That means that if they start to go too far down on interest rates and inflation starts to rise above that 4.5%, the financial markets, and I know that's never a popular thing to say, but in the end, South Africa has invited a lot of participants into its financial markets from offshore. You know, we've asked them to lend us money, basically, because we haven't been able to afford anything ourselves. So if inflation then starts to pick up, because now you've created too much demand, and you start to create too much inflation, well, they're going to start to discount the credibility of monetary policy, because you're not sticking to your target. That's one side of this. The other side of this is that this sounds very orthodox, but unfortunately I think just financial markets do work in a very orthodox manner. So you can become unorthodox, but you've got to do it in a very measured way. Now, the orthodox way of looking at this is that when you're running fiscal policy, which is loose, which basically means your budget deficits just keep getting wider as a percentage of GDP, the anchoring effect there is to get stricter on monetary policy. As an anchor, you've got to balance the two out in order to keep some type of credibility in the economy.
Okay, I mean, I get all about why all of that's important, but talk to me about the price of bread. Okay, so if interest rates were cut dramatically, would that push the price of bread up?
Well, look, this starts coming down to what is pass-through doing in the economy. So I'd be very quick to say that there's less ability of inflation to rise now as it has been in previous cycles. So in the cycles that Duma was talking about, certainly we would get the currency exchange rate weakening. Very soon, within 12 months, inflation would just pick up and we would roller coaster out of the 6% target ceiling up into double digits. That pass-through ability has reduced. Reduced because we haven't grown as an economy, reduced because companies have had to find very smart ways to rather push volumes, not push prices through to consumers, knowing that consumers are weak. So in other words, if they have structurally changed to new strategies, that means that in the event, let's just say the currency had to depreciate by 20%, let's not use bread, let's just use the currency for example, you're not going to get the same inflation effect as you would have in the past. So at least you've got some cushioning by being around the 4.5%. So what I'm trying to get to here is that I'm not so sure something as aggressive as going down to 3% is the right thing to do. I mean, you're talking about negative real rate territory for an emerging market that hasn't got a very good track record of its own finances, probably not a good place to go. But certainly at this point, we can expect some rate cuts. Maybe not that much, but certainly inflation is low enough, growth is certainly low enough, and rate cuts are definitely possible.
What's a real rate?
Oh,
Negative
sorry.
real rate.
So a real rate is when you take the nominal rate that you're talking about, the 6.75, and you deduct inflation, but technically inflation in 12 months' time. So if you take 6.75...
So you lose money in the end?
Yeah, exactly.
Okay.
Exactly.
Right, I mean, this is all about losing money. All right, we're going to continue this conversation. I mean, the real issue, I suppose, is if rates were cut, if the mandate were changed, would jobs be created or not? Our conversation about the mandate of the Reserve Bank will continue. Don't go away.